Okay, so next let us go to in corporate finance. What is NPV and IRR, and how to choose projects. Okay, when you have NPV and IRR saying different things. So before we go into that, let us see what are conventional and non-conventional cash flows. So we have two types of cash flows: conventional cash flows and non-conventional cash flows. So in conventional cash flows, you will see after the initial outflow or outlay, you have a series of positive cash flows or inflows. So you have one outflow at beginning. So this is negative minus CF0. Then you have inflows CF1, CF2. This is at the end of period 1, period 2, period 3, period 4. Like if you take a bond, if you buy a bond, after you purchase the bond, you can expect a series of coupons. So they are cash inflows. So this is, and finally of course you get the final cash flow, which includes the coupon and the redemption of the principal, okay, of the instrument. So this is a conventional cash flow. On the other hand, you can also have a cash outflow, initial cash outflow, followed by a mix of inflows and outflows. For example, CF1 is positive, but CF2 is negative, and this is positive, and this is negative. So when you have such a type of a series of cash flows, these come under non-conventional cash flows. Like when you are buying a stock, or when you are buying a fund or an ETF. So after you buy initially, you'll get some maybe dividend, or maybe you realize some gain, and then the price comes on, you will want to buy more, you average the cost. So this is an example of a non-conventional cash flow. Now we also need to understand in project when you are doing projects, what are independent projects and mutually exclusive projects. Now independent projects means like the cash flows are independent of each other. When there are two projects, like if you choose one, you can, there is nothing stopping you from choosing the other one as well. But but if two or more projects are classified to be mutually exclusive, you can choose only one of them, one of the two or one of the three. You cannot choose others. So such a situation, they are called mutually exclusive. Then we have also called what is project sequencing. So to reduce the risk, you don't execute all the projects at one time. You do one after the other based on the outcomes. If you're getting favorable outcomes, you go for the next project, or you basically stop going further once the outcome is not favorable. So this is called project sequencing. Then there is also one more term called capital rationing. Because capital is a limited resource, so there may be funding constraints. So you have to choose the capital for projects where you can expect maximum value. So the high NPV projects you should choose. This is called capital rationing. Now, what is the definition for NPV? NPV is simple. It is the discounted cash flows, or the summation of or you said sum the discounted cash flows at a particular rate of return, and then subtract the initial outlay. NPV stands for net present value, as you all know. So NPV equals sigma, that is summation of cash flows occurring at various points time t, discounted by a rate of return. T is from 1 to n. Suppose there are n periods, minus outlay. What is the investment you make? That is outlay. Now if NPV is greater than 0, then only you should choose it, you should invest. So to invest into a project, its NPV for project I should be greater than 0. If it should be greater than 0 only, you should invest. On the other hand, what is the IRR? IRR is the internal rate of return, is the discount rate that satisfies the equation, that is NPV equals 0. The same thing, if NPV equals 0, here that rate of return is IRR. If you do it by IRR, that is equal to outlay. T from 1 to n. So this rate of return which satisfies the equation, that is called IRR. Now you should invest if the IRR is greater than a hurdle rate. That is the minimum rate of return acceptable to you. You should invest only when IRR is more than the hurdle rate, otherwise you should not. Now there are two more terms called payback period and discounted payback period. So payback period refers to the number of years required to recover the original investment in a project. To recover the outlay or initial investment, how many years it takes? Simple number, years. Now this doesn't convey certain crucial things about the project, like the cash flows are not discounted by the project's required rate of return. So different projects have different rates of return. So they are not discounted, just without discounting you are telling. And it also ignores the time value of money because you are not discounting, and also the riskiness of the project. Some projects with high rate of return means they are more riskier. And it ignores the cash flows after the payback period is reached. So payback period, you recover the entire investment, but after that what happens, it does not say. So these are the drawbacks of payback period. So to avoid to overcome this shortcoming, there is another thing called discounted payback period, which is the number of years it takes for the cumulative discounted cash flows from a project to equal the original investment. So you have a series of cash flows, then you sum, that is the cumulative cash flows, and then you have to take the discounted cash flows and then the cumulative discounted cash flows. So let me show you how it comes. Suppose you have the cash flows like this. Here 0, 1, 2, 3, 4, 5. So I'll put the cash flow. Initial investment minus 5 million. You can say minus 5,000. Okay, you can put it, if it is in 1,000, it is 5 million. Minus 5 million. Then you get 1.5 million like this. Equal cash inflows over 5 years. So this is the cash inflow. So what is the cumulative? Cumulative means you have to sum cash flow. Cumulative cash flow. So this is minus 5,000. This, if you sum with this, it will be minus 3,500. This will be minus 2,000. This will be minus 500. This will be 1,000. This will be 2,500. So the payback period is coming to 0 between year 3 and year 4. So the payback period is between year 3 and year 4. So what is the payback period? Is equal to 3 years plus some n. Now this n is like this. Now this minus 500 should become 0. So it is 500, it had to go up by 500 divided by the next period, that is 1500. So 1/3. So that is payback period is 1/3 year. The payback period of this particular project is 3 1/3 year. But if you take the discounted cash flow, say at a particular rate of return, what happens is the discounted cash flow, maybe you do at the rate of 6% or 7%, it comes like this. So this will not change because it is 0, period 0. This 1500, when you discount, it comes smaller, 1364, and this is over 2 periods, it will be even smaller. This will be 1127, this will be 1025, and this is 931. Now you do the cumulative cash flows. Cumulative cash flows minus 5000, then you add this 1364, so minus 3636, then you add again minus 2396, then you add again minus 1269, then you add this one minus 245, then you add this 686. So here it is becoming positive that you recover this between year 4 and 5. So the discounted payback period is between year 4 and 5. Is equal to 4 year plus n, and that n you have to calculate like this. So this is minus 245 should become 0, means it has to increase by 245 divided by the next period, the cash flow 931. So that is equal to 4.24 year. So as you can see, the discounted payback period is more than the payback period for this project. So this is how it comes. And there is one more thing which is called the profitability index. Profitability index of a project. So that is defined like this. Profitability index PI is equal to 1 plus NPV divided by initial investment. So if the NPV is high, then PI will be PI, if it's greater than 1, then only you should invest. Means NPV should be greater than 0. NPV should be positive. So this is the profitability index. Okay, thank you.